In this video, I'm going to talk about something a little different. Most of the content I put out there, whether it's writing or video or even just social media on Twitter or LinkedIn, I spend most of my time talking about different investment concepts. The reality is I also run an asset management firm, and there are things that I do behind the scenes, things that I think about that I don't often talk about. And one of those things is managing the risk of the asset management firm. And there is one key metric that I have been using for years that I think is really important in thinking about managing the risk of my business. And I think it's highly relevant not only to asset managers, but also financial advisors. And so I wanted to make a video about what the metric is, how you can use it, and why I think it's useful. To set the stage and give a little bit of context, I want to go back a couple of years to an article written by Meb Faber, who is the Chief Investment Officer and co-founder of Cambria Funds. And the context of this article was the idea that financial advisors have far more exposure to markets than they probably think they do. And so Meb listed a few ways in which advisors might actually be implicitly levered to the market. The first is just in their own personal accounts. If you're a financial advisor, it's very likely that you have exposure to stocks and bonds in your own personal account. And so you are subject to the fluctuations of stocks and bonds. The second is in your practice in the short term. Most advisors charge a fee on assets under management, and if those assets shrink because it's an equity bear market, or as we saw in 2022, a bond bear market, well, what that's ultimately going to imply is your short-term cash flow is going to take a hit. Meb also pointed out that once you go from a short-term bear market to a long-term bear market, some of these problems can compound. Not only have your assets now shrunk potentially for longer, but client behavior begins to change. They might not be as willing to contribute from savings. Some might even have to begin withdrawing assets to make up for the fact that they might have lost their job. And so an advisor's business becomes very cyclically sensitive to the behavior of the investments that their clients are in. The fourth thing that Meb pointed out was that advisors who are part of a larger corporation, if the larger corporation has issues with cash flow, those advisors could end up out of a job. What I would add to this list is if you are not an advisor who works for a larger corporation, but you're a financial advisor who owns your own business, well, the equity value of your business is typically measured as a multiple of revenue. And if you go into a prolonged bear market and the value of the assets that you're overseeing shrinks significantly, that also means the value of your firm shrinks significantly. So at least on paper, your illiquid net worth is taking a hit at the same time as your firm's cash flow and revenue. And so when we put all that together, it just simply means that financial advisors, as well as asset managers, have a huge amount of sensitivity, individually and at a firm level, to what's happening in financial markets. And so this brings us to the metric that I have used for years. I look at it almost every single month. I recalculate this number to try to get a sense of risk at my firm. And that metric is what I call the revenue-weighted average portfolio. All right, that's kind of a mouthful. What is the revenue-weighted average portfolio? So every month what we do at my firm is we look at the mandates that we oversee, whether they're in ETFs or mutual funds or separately managed accounts or model portfolios, whatever it is. We put them into a spreadsheet and they're all classified by exposure. And with that mandate is also going to be the revenue that we expect to generate from that mandate. I then create a portfolio where I assume each mandate is held in proportion to the amount of revenue that it will generate for the firm. So a really simple example, let's say I run a stock mandate and a bond mandate, and the stock mandate is responsible for generating 60% of the firm revenue, and the bond mandate is responsible for generating 40% of the firm revenue. Well, then my revenue weighted average portfolio would be 60% stocks and 40% bonds. So this metric is really useful in trying to figure out, well, how volatile is my firm revenue going to be, and what are my key risk factors? As an example, a few years back, my firm won a $700 million mandate. The mandate was to implement an equity trend following strategy, and that mandate significantly skewed the revenue weighted average portfolio that my firm had. We now were significantly skewed towards equities rather than being more well diversified, and significantly skewed towards the results of trend following as a strategy. So for me as a business manager, not only did I look at that and say, okay, I need to do my best to make sure that that client is happy, but I had to work with my business development team to say, how can we try to grow the other mandates that are less equity-centric in our business so we can, again, try to diversify this pie. So how does this apply to financial advisors? So for example, if you work primarily with retirees, your revenue-weighted average portfolio is likely dominated by bonds. Volatility in interest rates, which can be driven by inflation volatility or unexpected changes in central bank policy, is likely going to be the leading driver of your revenue volatility. Conversely, if you do most of your work with growth clients, well, then it's likely that your revenue-weighted average portfolio is very equity-centric. And in that case, it would probably be prudent to plan for periods where your revenue retracts by 30 to 50% simply because of the fact that it's highly likely over the next 3, 5, 10 years that you go through a period of significant equity drawdown. Now, most financial advisors don't actually run mandates, they run blended portfolios. And if that's you, don't worry. It's just as simple as looking at each of those different maybe model portfolios that you run, figuring out the amount of revenue that each model portfolio is going to contribute, and then averaging them together in proportion to the revenue that they are going to contribute. So if you generate, say, 50% of your revenue from clients who are in a 60-40 portfolio and 50% of your revenue from clients who are in a 20-80 portfolio, well, then your revenue-weighted average portfolio is going to be a 40-60. So while I'll often argue that diversification is a really important concept for investors, I think the revenue-weighted average portfolio makes it clear that diversification is a really valuable concept to asset managers and advisors as well, in terms of the stability that it can bring to their business. In my ideal world, the revenue-weighted average portfolio would be well diversified, really able to weather any market condition, and therefore providing a stable revenue stream for the business. And I think this is where advisors and their clients are incredibly well aligned. The more certainty a client has in their financial plan, the more stable the cash flow should be for the financial advisor. So while you'll often hear me or us on this channel talk about alternative investment strategies and how you might be able to use return stacking as an investment concept to introduce them into your portfolio, it's not because alternatives are inherently good, it's because we believe that diversification is inherently good. Called the only free lunch on Wall Street, combining uncorrelated assets into a portfolio allows wealth to compound with greater consistency. So if you're a financial advisor, finding ways to introduce diversification into your client portfolios not only has the possibility of increasing the resiliency of their financial plan, but it also has the possibility of increasing the stability of your business. So if you've got any questions about this revenue-weighted average portfolio idea, honestly, I wish I had a better name for it. It's such a mouthful, and I've had to say it so many times in this video. Revenue-weighted average portfolio. If you have any questions, please leave a comment below. I will do my best to get back to you. Or if you have any other questions about the concepts of diversification or return stacking, we're here to help. If you found the ideas in this video valuable, I'd really appreciate it if you could like and subscribe. It helps this channel grow. And if you want to check out some of the other stuff we're doing, you can head over to returnstack.com. Thanks for watching, and until next time, happy stacking.